Okay, I want you to brace yourself for a figure that sounds, well, frankly shocking. $200 silver. Now, this isn't just some wild guess. This is what Michael Oliver, one of the most respected names out there in metals analysis, he's saying this price shock isn't just possible, it's been triggered, it's imminent. And here's the real kicker. This is why it matters right now. Oliver isn't talking about waiting a decade. No, he's predicting a really compressed, explosive move set to unfold in just a few quarters. He actually calls this whole setup the $200 silver trap. He sees it as a monumental wealth transfer just waiting for those who get the signals. So our mission today is simple. We're going to zero in on Oliver's latest, very urgent warning. We'll extract the core metrics, look at the historical precedents, and pinpoint the critical signals he shared supporting this massive prediction. By the end of our conversation, you'll get exactly why he believes silver is set to just go vertical, and you'll know precisely which market actions are supposed to confirm that launch is happening.
Yeah, and because getting this kind of intelligence quickly is crucial. Look, if you value market insights, if you want critical analysis that actually gets ahead of the curve, you really need to subscribe to Gredvia, like right now.
Yeah.
Don't wait around. Information on these launch signals. It requires continuous, fast delivery. So yeah, subscribe.
Okay, all right, let's unpack Michael Oliver's core argument here. Interestingly, he doesn't actually start with silver. He grounds this, well, pretty radical prediction in gold's established history, its blueprint. And that's crucial because gold, it broke out earlier. It's already kind of provided the pattern, the dimensional map for the whole metals sector.
Right, the gold blueprint. So what exactly is that telling us? What's the pattern? It talks in dimensions. Oliver points out that since gold was legalized back in the mid-70s, it's completed two massive and importantly repeating eightfold cycles. So the first one went from the 1976 low, about $103, and surged up to the 1980 peak around $850. That's your eightfold move right there. Then the second cycle, it started from the 2001 low, 2060-ish, ran all the way to the 2011 peak near $1,960. Again, same dimension, eightfold.
Okay, hold on. For people maybe less familiar with the charting side, when Oliver says logarithmic scale dimension, what does that really mean in simple terms? Is it just saying the percentage gains were the same?
Essentially, yes. It means the percentage move, right, when you plot it over time, resulted in the same relative expansion. It doesn't matter what the starting price was. It's about proportional growth. Now, the time it took was different, about 4 years the first time, 10 years the second. But let's say, the total energy release, the scope, was identical. And that repeatability, it suggests a really deep underlying structural pattern in the market.
Okay, so if that pattern holds, then Oliver must be saying gold is currently, what, halfway through its third eightfold run? Where are we now based on that?
That's exactly his point. Gold kicked off this current cycle from its 2015 bear market low, which was around $1,043. It's since climbed up to roughly $4,200. Now, that's a little more than 4 times its starting point. So yeah, halfway there. Therefore, if gold just follows the path it's set twice before, completes that full eightfold dimension, well, he projects a target heading towards $8,500 gold.
Wow, $8,500 gold. That's a massive target.
Yeah.
But like you said, gold's halfway there. Silver, though, silver feels, I don't know, stuck. Like it's just lagging way behind. What makes Oliver so sure that silver, the laggard, is actually the real explosive play right now?
The lag is the entire point. That's the key. While silver generally moves month to month with gold, Oliver's emphasizing that it's only just now starting to emerge from what he calls the 50-year price cage. Just think about that for a second. 50 years. Silver's basically been stuck in the same kind of, frankly, boring decade-long sideways churn that gold went through twice before, after 1980 and again after 2011. But for silver, that ceiling, that range, it's lasted half a century. And we are finally, he argues, definitively breaking out of that multi-decade range now.
Like 50-year ceiling. It's got to be a huge psychological barrier for investors. I get that. But why does he think the correction has to be so violent? Why $200? Why can't it just sort of drift up slowly?
Because of what he calls profound real value distortion. This is, I think, Oliver's strongest fundamental point. He argues silver has just failed, like spectacularly failed, to compensate for monetary degradation. Think about it. If silver had simply kept pace with how much the US dollar's real buying power has dropped since 1980, or heck, even just since the 2011 peak, it would already be priced well over $200 today. It hasn't caught up.
So markets basically made a huge decades-long error in pricing silver relative to how much our money has been devalued.
Precisely. And Oliver uses this really powerful analogy. Markets that get depressed, held down artificially for way too long, they eventually overcompensate for that error when they finally break free. They come roaring out of the hole in a really compressed time frame. It's like a bubble top bursting, but in reverse. All that pent-up pressure from 50 years of mispricing, it demands an immediate aggressive correction. That's why he expects vertical acceleration, not some slow, gentle climb.
Okay, before we get to the main trigger signal he's watching, let's talk about the noise because, just this week we saw some pretty scary short-term dips. The kind that would freak out most retail investors. Oliver specifically talked about that recent volatility, right? Pointed out like a 6% sell-off early in the week, maybe made worse by options expiration stuff.
Exactly. And most people see those 5%, 6% drops and they immediately think, uh-oh, rally's over. Get out. They see a big red flag.
But Oliver gave a really crucial kind of counterintuitive lesson right there, didn't he?
He absolutely did. He pointed out, look, despite those two scary-looking 6% dips within the week, silver actually finished the week 6% up. So his instruction is crystal clear. You have to buy the 5% to 6% breaks. He stresses this every single prior historic surge, whether it was that massive vertical lift in 79.80 or the run up towards $50 in 2010-11. They all included these exact same scary-looking sharp dips right before the market really launched. They aren't signs of failure. Oliver says they're the market shaking out the weak hands, consolidating fuel for the next big leg up, buying opportunities.
Right. And look, if you value that kind of time-sensitive insight, the kind that tells you if a 6% drop is a disaster or actually a discount, you really need to subscribe to Credvia. Like now, this is where you find these critical signals before everyone else catches on. Seriously, hit subscribe. Okay, let's pivot then. Let's talk about the absolute primary signal Oliver says we have to watch. He really emphasizes that the critical indicator, the thing that predicts the dramatic surge phase, isn't just silver's price action itself or its momentum trend alone.
Yeah.
So what is it? What's the most crucial overarching signal?
It's the spread relationship, plain and simple, the gold to silver ratio. This spread, he says, acts like the tripwire for silver's explosive performance. Every single major silver surge in history, think 79.08, think 2010-11 they began when this ratio collapsed, meaning silver suddenly started vastly outperforming gold almost overnight, it seemed.
We need some numbers here. What's the ratio doing right now, and what target does Oliver need to see hit to really confirm this launch mode is engaged?
Okay, so historically, the ratio often hangs around, say, 75.1 to 85.1, meaning, it takes 75 to 85 ounces of silver to buy 1 ounce of gold. Pretty widespread. Oliver's observation now is that this spread has definitively bottomed out. It's coiling for launch mode, as he puts it. It's pressing up against key momentum levels, probably hitting some long-term moving averages. And that indicates that any further relative move, any strengthening of silver versus gold from here will kick off that dramatic surge phase. It'll repeat those prior pivot points where the ratio just plunged. When silver takes the lead, that ratio falls hard and fast. And remember, during its most powerful surges in the past, silver reached about 33.1 against gold. So Oliver's saying the technical setup is now in place for the ratio to start that violent compression again, signaling silver's about to just sprint ahead of gold.
Okay, that makes sense. And that brings us right to the speed, the velocity, and the ultimate math. You mentioned gold's last big surge took, 10 years? Why should we believe silver's move is going to be squeezed into just a few quarters this time? What makes it so fast?
Well, it's that overcompensation mechanism we talked about, combined with just how thin the silver market can be when big money moves in. Oliver points out that those final blow-off moves in silver, like remember the rush from the $20 something level up to near $50 back in 2010, 2011, that basically tripled the price in about 5 or 6 months.
That's market physics, right? Reacting violently to a correction that's been delayed for too long. And because this error, this mispricing, is 50 years in the making, he expects the resolution to be similarly compressed, unfolding in just a handful of months or, maybe a couple of quarters at most. It'll happen faster, he believes, than the traditional financial world can even react to it.
And this speed connects right back to justifying that $200 number. Okay, let's run the math one more time using Oliver's framework just to be clear. Absolutely. So first, we establish gold's potential target, based on repeating history, is around $8,500. Okay. Then we just apply historical ratio norms to that gold price. Over the last 50 years, if silver merely returns to being priced at 2% of gold's price, which is actually a pretty conservative general historical normal, 2% of $8,500 gold gets you $160 silver. Now, that's already almost a 6-fold increase from recent price levels just to get back to a sort of baseline historical relationship.
But the really explosive target, the $200 plus SU, that needs silver to perform like it did during the peak phases of those previous bull runs.
That's correct. The $200 plus target comes into play when silver manages to return to 3% of gold's price. We saw that kind of ratio during those high-velocity bull market years like 79.80. So if gold hits $8,500 and silver achieves that 3% ratio, the price is comfortably over $200. So Oliver's bottom line is basically a minimum target of $100 silver, but with a really strong likelihood of $200 or even more, driven purely by catch-up performance and that violent compensation for decades of being undervalued.
Okay, wow. Let's try and summarize Oliver's core message right here then. It seems like the clock has started, based on really three pillars of evidence. First, gold is halfway through its big mega cycle, confirming the map. Second, silver is breaking out decisively from that 50-year structural cage caused by, well, massive monetary mispricing. And third, that crucial gold-silver ratio, the historical launch signal, is now coiled up and looks primed to collapse, meaning silver takes charge.
Exactly. And that leads directly to Oliver's instruction for you, the listener. Do not wait for confirmation. He's very clear on this. He says the price action is going to accelerate so rapidly that if you aren't positioned before the breakout becomes common knowledge, you'll simply miss the bulk of the move. This isn't an opportunity, he argues, that gives you months to think it over.
It sounds incredibly compelling, almost inevitable based on his technical framework. But is there any market action or maybe a failure of those key ratios that could potentially invalidate this or at least postpone it?
Well, Oliver's analysis really suggests the only thing that could derail the technical inevitability here would be some kind of fundamental U-turn in global monetary policy, central banks suddenly becoming incredibly hawkish, which, let's face it, he finds highly unlikely. The momentum factors are apparently so aligned now, only a massive, truly unforeseen external shock could likely halt the launch sequence at this point. He seems to believe the technicals are just too far advanced. The time for dithering, he says, is over. And that brings us to a final provocative thought, maybe connecting this all back to the bigger picture. Oliver explicitly links this surge he sees coming. He links it not just to chart patterns, but to what he calls far more dramatic global and fundamental conditions than we saw in the prior bull runs. Specifically, the ongoing aggressive degradation of money units, fiat currencies, by central banks all around the world.
So, okay, if Oliver's right, and we actually see $200 silver driven by this massive fundamental error, this need to compensate for decades of fiat currency destruction. What does a price move of that sheer magnitude truly signal about the future, about the stability, the real purchasing power of our everyday currencies? It kind of suggests the correction for this error is going to be, well, immense and probably painful for anyone left holding just paper assets.
That's a really powerful point to reflect on, absolutely. And look, to make sure you never miss our analysis on these launch signals as they appear, and Oliver says that ratio could break dramatically literally any week now, you absolutely must subscribe to Credvia immediately.
Stay sharp, stay aware out there. Thanks for joining us for this analysis. We'll catch you on the next one.